Welcome back to Boni's Life, where we decode the crypto universe with the precision of a Swiss watch and the enthusiasm of a kid in a candy store. I'm Boni, and if you're watching this on August 3rd, 2025, you've just witnessed one of the most fascinating weeks in crypto history. We've got tariff tantrums, trillion-dollar predictions, and enough technical signals to make even the most seasoned trader reach for their coffee. Today, we're diving deep into three critical segments that could make or break your portfolio this week. First, we'll dissect last week's market performance with surgical precision, examining why Bitcoin's dance with the $113,000 level tells us more about market psychology than any headline ever could. Then, we'll peer into our crystal ball, which, by the way, is powered by data, not wishful thinking, to forecast what August has in store for us. Finally, we'll arm you with actionable trading strategies that work whether you're a DeFi degen or a conservative hodler. But before we begin, let me share something that perfectly captures this moment in crypto history. Michael Saylor recently said, "Bitcoin is money, everything else is credit." Now, whether you agree with that statement or think Michael's been spending too much time in the Bitcoin rabbit hole, one thing is undeniable. Institutional adoption is accelerating at a pace that would make a Tesla Model S Plaid jealous. Speaking of institutions, JP Morgan just announced a strategic partnership with Coinbase that's bigger than most people realize. We're not just talking about another corporate handshake here. This is the traditional financial world officially rolling out the red carpet for crypto. When the bank that once called Bitcoin a fraud starts letting customers fund their Coinbase wallets with Chase credit cards, you know we've crossed the Rubicon. So grab your favorite beverage, settle in, and let's navigate these turbulent but incredibly exciting waters together. Because in crypto, as in life, fortune favors the prepared mind. Let's start with the elephant in the room. Or should I say, the orange elephant that just announced reciprocal tariffs on 90 countries. Last week's market action was a masterclass in how external macro events can trigger cascading effects in crypto markets, and if you understand the mechanics, you can position yourself ahead of the crowd. Bitcoin opened the week trading comfortably above $116,000, riding the momentum from July's impressive 8% gain. But by Friday, we saw a sharp 3% decline to $113,231. And here's where it gets interesting from a technical perspective. This wasn't just random selling. It was a textbook example of what I call risk-off reflexivity. When President Trump announced those tariffs ranging from 10% to 41% on dozens of countries, the immediate market reaction was predictable. Investors fled to safety. But here's the fascinating part: crypto, which many still consider a risk asset, actually held up better than most traditional risk assets. While crypto stocks like Coinbase plummeted 16% and MicroStrategy dropped 8.7%, Bitcoin's 3% decline was relatively modest. Now, let's talk about what the charts are really telling us. Rakesh Upadhyay from Cointelegraph highlighted something crucial that most traders missed. Bitcoin has pulled back to the neckline of an inverse head and shoulders pattern. For those new to technical analysis, this is like finding a treasure map with a big X marking the spot. The neckline at around $113,000 is now the most critical level to watch. If Bitcoin can bounce from this level with conviction, and I mean real conviction, not just a weak bounce that fades within hours, we could see a rapid move toward $123,200, break above that level, and suddenly $135,000 comes into play. But here's the kicker: if we lose the neckline decisively, the next major support doesn't come until $105,000, with $100,000 acting as the psychological floor. The liquidation data tells an even more compelling story. We saw $228 million in Bitcoin liquidations and $262 million in Ethereum liquidations across centralized exchanges. This wasn't organic selling. This was forced selling from over-leveraged positions. And you know what happens after forced selling? Smart money steps in. Ethereum's performance last week was particularly noteworthy. While Bitcoin struggled, ETH showed relative strength, declining only 6% compared to Bitcoin's broader weakness. This divergence is significant because it suggests institutional money is rotating from Bitcoin to Ethereum, possibly in anticipation of the upcoming EIP 9698 proposal that could dramatically increase Ethereum's capacity. The technical picture for Ethereum is actually more bullish than Bitcoin's right now. ETH is testing its 20-day simple moving average at 3,590, which has acted as reliable support in previous corrections. If this level holds, we could see a quick bounce toward $3,141 with $4,794 as the next major resistance level. But let's zoom out and look at the bigger picture. July was a monster month for crypto, with Ethereum surging over 49% while Bitcoin gained a more modest 8%. This performance differential is telling us something important about market dynamics. Institutional investors aren't just buying crypto anymore, they're becoming sophisticated about which crypto they're buying. The ETF flows paint a crystal clear picture of this trend. Ethereum ETFs saw over $5 billion in inflows during July alone, bringing total cumulative inflows to $9.64 billion. Meanwhile, Bitcoin ETFs, despite their longer track record, saw $6 billion in monthly inflows out of a cumulative $55 billion. The velocity of Ethereum adoption is remarkable. Now, here's where the technical analysis gets really interesting. We're seeing what I call triple RSI bearish divergence on Bitcoin's weekly chart. This sounds scary, but it's actually quite normal in bull markets. The price keeps making higher highs while momentum indicators show weakening strength. It doesn't mean the bull market is over. It means we're due for a healthy correction that shakes out weak hands. Solana's performance last week deserves special mention. Despite the broader market weakness, Sol only declined 5%, and the network fundamentals remain incredibly strong. The Solana network has maintained 100% uptime for nearly 16 months now, and with plans to double block space by 2025, the technical foundation for higher prices is solid. One metric that's flying under the radar is the stablecoin market expansion. Total stablecoin market cap reached $263 billion throughout 2025, up from $205 billion at the start of the year. This isn't just growth. This is explosive growth that indicates massive capital inflows into the crypto ecosystem. The most telling technical signal from last week wasn't in the price action, it was in the options market. Put-call ratios spiked to levels we haven't seen since the March correction, indicating extreme fear among retail traders. But here's the contrarian insight. When retail is maximally fearful, institutional money tends to step in. As we wrap up this technical analysis, remember that markets don't move in straight lines. Last week's correction was healthy and necessary after July's explosive gains. The key levels to watch this week are Bitcoin's $113,000 neckline support and Ethereum's $3,590 moving average support. Hold these levels and we could see a powerful bounce. Lose them and we might need to test deeper support levels before the next leg up begins. Now let's shift gears from charts and indicators to the fundamental forces that will drive crypto markets this week. And folks, we've got a perfect storm brewing, the kind that either sinks ships or creates legendary trading opportunities. The macro environment is absolutely fascinating right now. We just got July's jobs data, and it was weaker than a decaf espresso. Only 73,000 jobs were added versus the expected 110,000. Normally, weak jobs data would be bearish for risk assets, but in our current environment, it's actually bullish for crypto. Why? Because it increases the probability of Federal Reserve rate cuts. and lower rates historically drive capital into alternative assets like Bitcoin and Ethereum. But here's where it gets interesting. The Fed doesn't meet again until September, which means we're in this weird limbo where markets are pricing in rate cut expectations without any immediate catalyst. This creates what I call anticipation alpha, the opportunity to position ahead of the crowd. Speaking of positioning, let's talk about the institutional developments that are reshaping the entire crypto landscape. The JP Morgan Coinbase partnership announced this week isn't just another corporate deal. It's a seismic shift in how traditional finance views crypto. When Melissa Felcher, JP Morgan's head of payments and lending innovation, says this partnership marks a significant step forward in empowering customers to take control of their financial futures, she's not using corporate speak. She's acknowledging that crypto has become essential financial infrastructure. The partnership includes 3 game-changing features: direct bank-to-wallet connections through JP Morgan's secure API, the ability to transfer Chase Ultimate Rewards points to Coinbase accounts, and this is huge, the ability to use Chase credit cards to fund Coinbase accounts starting this fall. This isn't just adoption. This is integration at the highest levels of the financial system. But let's talk about the elephant in the room. Or should I say, the trillion-dollar elephant. Cathie Wood's latest prediction that Bitcoin could reach 1.5 million by 2027 has everyone talking. Now, before you dismiss this as hopium, consider the methodology behind ARK Invest's analysis. Their bull case isn't based on wishful thinking. It's based on scarcity dynamics, institutional adoption curves, and Bitcoin's evolving role as digital collateral. Even ARK's bear case predicts Bitcoin reaching $300,000, which represents a 217% gain from current levels. When one of the most respected institutional investors in the world puts out numbers like this, markets listen. And more importantly, other institutions start modeling similar scenarios. Michael Saylor continues to be the most bullish voice in the room, recently announcing MicroStrategy's plan to raise $4.2 billion to buy more Bitcoin. His 15-year prediction, which he calls shocking, involves global monetary shifts that could make Bitcoin the primary store of value for institutions worldwide. Whether you agree with Saylor's vision or not, his company's Bitcoin strategy has generated massive returns for shareholders. Now, let's look at the specific events that could move markets this week. Tuesday brings us the latest inflation data with the Consumer Price Index report. This is crucial because it will show whether Trump's tariff policies are already pushing prices higher. If CPI comes in hot, it could delay Fed rate cuts and create short-term headwinds for crypto. But if inflation continues cooling, it strengthens the case for monetary easing. Wednesday's Producer Price Index will provide another inflation reading, but the real fireworks start on August 7th, when Trump's reciprocal tariffs officially take effect. This could create volatility across all risk assets, but crypto's 24/7 nature means it often leads rather than follows traditional market moves. The geopolitical calendar is equally important. Trump's ceasefire deadline for the Russia-Ukraine conflict hits on August 8th. Any movement toward peace could trigger a massive risk-on rally across all assets, while escalation could drive flight to safety flows. Bitcoin's role as digital gold means it could benefit either way, either as a risk asset in a rally or as a safe haven in a crisis. But the most significant event for crypto specifically is Bitcoin Asia 2025 in Hong Kong on August 28-29. This isn't just another conference, it's a statement about Asia's commitment to becoming the global crypto hub. With Eric Trump delivering a keynote and Hong Kong regulators speaking, we could see major policy announcements that reshape the regulatory landscape. The technical upgrades happening this month are equally bullish. Ethereum's EIP 9698 proposal could increase the network's gas limit to 3.6 billion over 4 years, potentially boosting transaction throughput to 2,000 per second. This would make Ethereum significantly more competitive with faster blockchains and could drive institutional adoption. Solana's continued scaling efforts are also noteworthy. Plans to double block space by 2025, combined with the upcoming FireDancer validator client, could cement Solana's position as the high-performance blockchain of choice for institutional applications. Token unlock events this week present both risks and opportunities. The $162 million SUI unlock on August 1st already caused price weakness, but smart money often uses these events as buying opportunities. The $22 million ENA unlock on August 2nd and the larger unlocks later in the month could create similar dynamics. Here's my prediction for this week. Bitcoin will test the $113,000 support level early in the week, possibly dipping as low as $110,000 before finding buyers. If the jobs data continues to show weakness and inflation data comes in benign, we could see a sharp reversal toward $120,000 by week's end. Ethereum looks stronger technically and fundamentally. I expect ETH to outperform Bitcoin this week, potentially testing $3,800 to $4,000 if it can hold above the $3,590 support level. The institutional rotation from Bitcoin to Ethereum is a powerful trend that's likely to continue. For altcoins, I'm watching Solana closely. The network's technical improvements and strong fundamentals could drive Sol toward $180 to $200 if the broader market cooperates. XRP's recent weakness creates an interesting opportunity, especially with the potential for regulatory clarity in the coming months. The stablecoin market expansion to $263 billion tells us that massive amounts of capital are sitting on the sidelines, waiting for the right entry point. This dry powder could fuel the next leg of the bull market once technical levels are reclaimed. All right, traders, this is where the rubber meets the road. We've analyzed the technicals, we've examined the fundamentals, and now it's time to translate that knowledge into actionable strategies that can help you navigate this week's opportunities and risks. Let's start with the most important principle. In volatile markets like we're experiencing, position sizing is everything. I don't care how confident you are in a trade. If you're risking more than 2 to 3% of your portfolio on any single position, you're gambling, not trading. The crypto market can humble even the most experienced traders, so respect the volatility. Strategy 1. The Bitcoin bounce play. Bitcoin's test of the $113,000 neckline support presents our first major opportunity. Here's how to play it. If Bitcoin holds above $113,000 and shows signs of strength, I'm talking about volume expansion and bullish divergence on shorter time frames, consider a long position with a tight stop loss at $111,000. Your target should be conservative $118,000 for the first take profit level, which represents the 20-day moving average. If Bitcoin reclaims this level with conviction, you can hold for a move toward $123,000. But here's the key. Take partial profits at each level. Don't be the trader who holds through a 10% gain hoping for 20% and ends up with a loss. For those who prefer option strategies, consider buying call spreads rather than outright calls. The $115,000, $120,000 call spread expiring next Friday offers good risk-reward if you believe in the bounce scenario. Just remember that options in crypto can be expensive due to high implied volatility. Strategy 2. The Ethereum outperformance trade. The ETH-BTC ratio has been strengthening, and this trend could accelerate this week. If you are bullish on crypto overall but want to hedge against Bitcoin weakness, consider going long Ethereum while shorting an equivalent amount of Bitcoin. This pairs trade lets you profit from Ethereum's outperformance without taking directional market risk. Alternatively, if you prefer spot trading, simply overweight Ethereum in your crypto allocation. The technical setup is cleaner, the fundamental drivers are stronger, and institutional flows favor ETH right now. A break above $3,650 could trigger a quick move to $3,800, $4,000. Strategy 3. The altcoin rotation play. While Bitcoin and Ethereum grab headlines, some of the best opportunities this week might be in carefully selected altcoins. Solana looks particularly attractive after holding up well during last week's correction. A break above $170 could trigger a move toward $190, $200. But here's the sophisticated approach. Don't just buy altcoins randomly. Focus on projects with strong fundamentals, upcoming catalysts, and technical setups that align with your risk tolerance. The upcoming token unlocks. Create both risks and opportunities. Use them to your advantage by buying quality projects at discounted prices. Strategy 4. The macro hedge. Given the uncertainty around tariffs, inflation data, and geopolitical events, consider hedging your crypto exposure with traditional safe haven assets. This doesn't mean selling your crypto. It means adding positions in gold, treasury bonds, or even the dollar that could offset crypto losses if macro conditions deteriorate. A simple approach is to allocate 10 to 20% of your portfolio to these hedges when crypto volatility is elevated. You're not trying to make money on these positions, you're buying insurance against tail risks. Strategy 5. The DeFi yield play. While everyone focuses on price movements, don't forget about yield opportunities in DeFi. With stablecoin yields still attractive and new protocols launching regularly, you can generate income while waiting for the next major price move. Consider protocols like Aave, Compound, or newer platforms that offer competitive yields on stablecoins. Just remember to factor in smart contract risks and only use protocols with strong security track records. Risk management rules for this week. First, use stop losses religiously. The market is too volatile to trade without them. Set your stops at logical technical levels, not arbitrary percentages. For Bitcoin, $111,000 is a logical stop for long positions. For Ethereum, $3,500 makes sense. Second, don't chase breakouts. Wait for pullbacks to enter positions, even if it means missing the first part of a move. It's better to enter at a worse price with better risk-reward than to chase and get stopped out. Third, take profits incrementally. The temptation in crypto is to hold for massive gains, but in volatile markets, it's often better to take smaller, consistent profits than to swing for the fences. Fourth, stay informed but don't overtrade. The 24/7 nature of crypto markets can lead to overtrading. Set specific times to check markets and stick to your plan. Advanced strategies for experienced traders. For those comfortable with more complex strategies, consider using futures and options to create synthetic positions. A long call combined with a short put can create synthetic long exposure with different risk characteristics than spot buying. Funding rate arbitrage is another opportunity in volatile markets. When funding rates spike due to excessive leverage, you can profit by taking the opposite side of crowded trades. Finally, consider cross-chain arbitrage opportunities. Price discrepancies between different blockchains can create risk-free profits for those with the technical knowledge to execute these trades safely. Remember, the goal isn't to hit home runs every week. It's to consistently make good decisions that compound over time. In crypto, as in life, slow and steady often wins the race. As we wrap up today's analysis, let's zoom out and remember why we're all here. We're witnessing the birth of a new financial system, one that's more open, more transparent, and more accessible than anything that came before. Yes, there will be volatility. Yes, there will be setbacks, but the long-term trajectory is clear. Crypto is becoming an integral part of the global financial infrastructure. This week's events, from JP Morgan's partnership with Coinbase to Cathie Wood's $1 trillion predictions, aren't isolated incidents. They're part of a broader narrative of institutional adoption that's accelerating faster than most people realize. When traditional banks start integrating crypto services and respected institutional investors start modeling seven-figure Bitcoin prices, we're no longer talking about a speculative bubble. We're talking about a fundamental shift in how the world thinks about money and value. The technical levels we discussed today matter in the short term, but don't lose sight of the bigger picture. Whether Bitcoin bounces from $113,000 or dips to $105,000 this week is less important than the fact that major institutions are building infrastructure to support much higher prices in the years ahead. For those of you implementing the trading strategies we discussed, remember that risk management isn't just about protecting your capital. It's about staying in the game long enough to benefit from the massive opportunities ahead. The crypto market rewards patience, discipline, and continuous learning. Before you go, don't forget to hit that subscribe button and ring the notification bell. We're living through the most exciting period in financial history, and I want to make sure you don't miss any of our analysis. Drop a comment below with your thoughts on this week's outlook. I read every single one and often feature the best insights in future episodes. Next week, we'll be diving deep into the Jackson Hole Symposium and what Fed Chair Powell's comments could mean for crypto markets. We'll also be analyzing the latest DeFi developments and sharing some exclusive insights from our institutional sources. Until then, trade safely, think independently, and remember, in crypto, as in life, fortune favors the bold but rewards the prepared. This is Boni, signing off from Boni's Life. See you next week.